Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 1 of understanding historical simulation, how it works and why it matters. Have you ever wondered how past data can guide future decisions? Historical simulation does exactly that. Used in fields like finance and risk management, it helps analyze past events to predict potential outcomes. By studying historical data, professionals can assess risks, test strategies, and make better decisions. Whether you're managing investments or solving complex problems, understanding this approach is key to staying prepared and informed. What is historical simulation? Historical simulation is a powerful tool for understanding patterns and making informed decisions. By using actual events from the past, it helps predict how similar scenarios might unfold in the future. This approach is widely applied in various industries to evaluate risk, test theories, or plan for uncertainty. Let's break it down further. Definition and overview. At its core, historical simulation is a method of analysis that relies on past data to simulate possible future outcomes. It works by taking historical records, like stock prices, sales figures, or environmental data, and replaying these events to see how they could influence current or future decisions. Instead of relying on theoretical models or assumptions, this method stays grounded in real-world events that have already occurred. Key components of historical simulation include historical data, the foundation of this method, providing a factual basis. Repetition of events. Past data is replayed under current conditions to predict future results. Risk assessment, often used to evaluate the likelihood of loss under past scenarios. For instance, in finance, a historical simulation might use past market movements to estimate the potential risk of a current portfolio. The process assumes that history tends to repeat itself, or at least rhyme, giving decision-makers a framework to anticipate what may happen next. Historical simulation in context. Though it's a staple in finance, historical simulation isn't confined to one sector. It has roots in broader fields like economics, science, and even engineering, where analyzing past behavior is essential. Why? Because patterns from the past often provide the clearest clues about what's ahead. Here's how it finds its way into different industries. Finance. Investment managers use it for value at risk, VAR, calculations, predicting potential losses based on historical market trends. Economics. Policymakers study historical economic shocks, like recessions or inflation spikes, to craft strategies for future resilience. Environmental science. Climate scientists analyze past weather patterns to forecast changes and prepare for natural disasters. Supply chain management. Businesses replay past production or logistics data to prevent disruptions and optimize operations. Why is historical simulation trusted? It strips away guesswork and relies on data that is already validated by reality. Unlike hypothetical models, this approach offers tangible insights by replaying scenarios people have seen before. That said, it also has limitations. If future conditions stray too far from historical trends, the predictions may lose accuracy. How historical simulation works. Historical simulation is a methodical process that takes raw data from the past and turns it into actionable insights. Used across various industries, this approach gives professionals a way to analyze patterns, test scenarios, and predict potential outcomes with confidence. Let's break down how it all comes together. Data collection and preparation. Every successful historical simulation starts with high-quality data. The process begins with gathering information from reliable sources that are directly relevant to the question or problem being addressed. For example, in finance, this includes stock prices, interest rates, or market indices. In environmental science, it might mean atmospheric or temperature records. Once the data is collected, the next step is cleaning it. Why? Raw data is often messy. It may include errors, duplicates, or gaps that can skew results. For example, removing inconsistencies, addressing errors like typos or incorrect values. Filling in gaps, using techniques like interpolation to estimate missing data points. Standardizing formats, ensuring all the data is uniform and ready for analysis. Think of data preparation as building a solid foundation. Without clean and accurate data, simulations can't provide trustworthy outcomes. Scenario analysis. Once the data is ready, it's time to test different possibilities. This involves creating hypothetical scenarios based on what has happened in the past. These scenarios help decision-makers anticipate what could happen in various what-if situations. For example, what happens if market conditions match a previous crash? How does a supply chain react under the same disruptions experienced last year? By replaying historical patterns, simulations allow professionals to mentally try out different situations without the risk of real-world consequences. This step is particularly useful in stress testing financial portfolios to anticipate potential losses, assessing how policies or strategies would perform under adverse conditions. This scenario-based approach adds a layer of preparedness to the decision-making process, ensuring fewer surprises down the road. Modeling and algorithms. Behind the scenes, mathematical models and algorithms do the heavy lifting. These tools take the cleaned data and historical patterns to generate predictions. Common techniques include probability distributions, calculating the likelihood of outcomes based on past variations; Monte Carlo simulations, simulating thousands of potential results to get a range of possibilities; weighted adjustments, giving more importance to recent data over older records to reflect current trends better. Think of these models as the engine of the simulation. They crunch numbers, identify patterns, and generate insights, all while staying grounded in historical facts. While complex on the surface, these algorithms provide a simple goal: to help leaders make better, data-driven decisions. Applications of historical simulation. Historical simulation is more than just a tool. It's a practical way to solve real-world problems by learning from the past. By leveraging previously recorded data, it helps predict potential outcomes, improve strategies, and manage risk. This method has a wide range of applications, offering insights into fields like finance, climate science, and epidemiology. Finance and risk management. In finance, historical simulation plays a central role, especially for calculations such as value at risk, VAR, and portfolio analysis. It provides a realistic way to measure and manage financial risks by analyzing past market behaviors. Value at risk, VAR. VAR estimates the potential loss a portfolio could face within a specific timeframe under normal market conditions. Historical simulation simplifies this process by using actual market data instead of theoretical models. For instance, by examining how a portfolio performed during past downturns like the 2008 financial crisis, analysts can estimate the worst-case scenarios for the portfolio today. Portfolio analysis. Investors use historical simulation to test how a portfolio might behave under a variety of market conditions. By replaying scenarios such as price shocks or interest rate changes, they uncover vulnerabilities and build more resilient strategies. For example, if a stock in the portfolio consistently underperformed during similar historical conditions, it might be worth reconsidering its inclusion. This approach is favored in finance because it cuts out assumptions, relying solely on concrete, historical data. It's like having a financial crystal ball, but instead of looking into the future, you're looking back to predict what may come next. Climate modeling. Historical simulation is critical in climate modeling, where scientists use past environmental data to map future trends. Climate change, after all, isn't random, it's a continuation of patterns we've seen before. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.